Well, welcome back. Americans are still reacting to a volatile week for the banking industry after the collapse of Silicon Valley Bank and also Signature Bank. Fed stepping in to help out both of those banks.
Absolutely. Joining us now for more is chief economist and host of the SchiffRadio.com, Peter Schiff. Thank you so much for joining us, sir. Is there a possible buyer for Silicon Valley Bank? What can we expect to happen next?
Well, I don't know if anybody wants to buy the bank. The problem is most of the banks now, I think, in the United States are technically insolvent. And this is the result of a dozen years of 0% interest rates and quantitative easing. The Federal Reserve created the first financial crisis with artificially low interest rates. And the current financial crisis is actually even worse because it kept interest rates even lower for longer. So we've already bailed out several banks and their large depositors. The President of the United States is pretending that this doesn't cost anybody any money. It's going to cost everybody because inflation is the way we're paying for this. The Federal Reserve's balance sheet is now blowing up. It's back to quantitative easing, which is the reason we got into this predicament in the first place. But everybody's bank account is now at greater risk than ever. Maybe not because your bank is going to fail, because the government is not allowing that to happen, but because everybody's bank account is going to lose value, because inflation is going to destroy the value of everybody's savings. Remember, a lot of these large banks that are putting money now in other banks, they're getting the money from the Federal Reserve. Remember, these large banks are able to take their treasuries and mortgage-backed securities, which have depreciated dramatically because they were foolish enough to invest when interest rates are at all-time record lows. So they're able to take paper that maybe is worth 70 cents and just give it to the Federal Reserve in exchange for $1. And then they're taking some of that windfall and depositing it in other banks. So the whole thing is a bailout in disguise. And again, the bag holder is the American public. They get the bill in the form of higher prices.
A new study from the Social Science Research Network found that nearly 190 U.S. banks could be vulnerable to a similar type of collapse as SVB. You know, the question on everybody's mind, is the banking system safe?
No, it's not. It's completely unsafe. But again, even if the government steps up and bails out all these insolvent banks and stops the runs, the only way they can do it is by printing trillions and trillions of dollars, and it gets spent into circulation. So either you're going to lose your money because your bank fails, or you're going to keep your money because your bank is bailed out, but your money isn't going to have much value. So what good is it if you can withdraw your money, but when you go to spend it, you can't buy very much?
Yeah, exactly right. And let's play a soundbite here from Treasury Secretary Janet Yellen on the interest rates, having said that.
My understanding is that the bank, to meet liquidity needs, had to sell assets that it expected to hold to maturity. And given the interest rate increases that have occurred since those assets, including treasuries and government-backed mortgage-backed securities, they had lost market value.
Unfortunately, the Fed is going to stop raising interest rates. It's already gone back to quantitative easing. They should be raising interest rates much more. And the government under Secretary Yellen should be cutting back spending. If she was competent as Secretary of the Treasury, she would be telling her boss, Joe Biden, that we need to dramatically cut government spending. Instead of trying to raise the debt ceiling so we can go deeper into debt, she should be advising her boss to start cutting spending and actually pay our bills so we don't have to raise the debt ceiling.
Right. Stop the bleeding, right?
And, you know, the media is reluctant to call this a financial crisis. They keep saying it's a banking crisis. The financial crisis of 2008 was a banking crisis. Nobody wants to say what it is because they don't want to invoke memories and comparison to 2008. But this is a sequel to 2008, and like all sequels, this one's going to be worse.
I've heard some other financial experts say this will be worse later this year than 2008 when these banks start collapsing. Are they being the boogeyman, or are they right?
Well, of course. Well, first of all, the reason we had a financial crisis in 2008 was because from 2002 through 2005-ish, the Federal Reserve held interest rates at 1%, and that gave birth to the adjustable rate mortgages, zero doc loans, nothing down. In that era of cheap money, we inflated a housing bubble, and a lot of these real estate loans, predictably, and I predicted that, went bad when the Fed eventually normalized rates and they got them back up around 5%. And then we had a financial crisis, but the government cut it short with QE and 0% interest rates. But now we've had 0% rates for more than a decade. The Fed has made far more monetary policy mistakes since the 2008 financial crisis than prior. And so it has inflated a much bigger credit bubble. Now the banks are in far worse shape than they were in 2008, especially the two big to fail banks that we bailed out and are now much bigger than they were back then and even more insolvent. So as a result of what the Fed has done after the 2008 financial crisis, this new financial crisis that just got started will be much worse. And my fear, which is already being validated by last week's balance sheet, is that this crisis is going to be so bad that the Fed is going to pull out the stops and print as much money as possible to bail everybody out. And then the inflation that we saw in 2021 and 2022 is just the tip of a huge iceberg. And we're going to be looking at double-digit annual inflation rates, really as far as the eye can see.
Let me ask you something about the bailout. So FDIC secures up to $250. That's it.
Well, first of all, the banks haven't paid enough into the FDIC because they only have $100 billion. We have $18 trillion worth of deposits. And you know where that $100 billion is? It's already been loaned to the U.S. government because it's sitting in U.S. treasuries. So they'd have to sell the treasuries in order to bail out the banks. But there's not enough cash there because the banks haven't paid enough. And by the way, in 2008, the insured deposit limit was only $100,000.
Right, we raised it.
It was raised to $250, but we shouldn't even have the FDIC. It was created by Roosevelt during the New Deal in the 1930s. It was an overreaction to the Great Depression. You know, without any government insurance, with all the bank failures during the 1930s, only about 2% of the deposits was lost. The banking system was much sounder before we had an FDIC than it is now, because back then banks had an incentive to be responsible because their customers held them accountable. But now there is no accountability.
Because we're giving them parachutes.
Nobody does any research. Does anybody care what the banks do with their money once they're deposited? No. And even the large investors or depositors, the people that had millions and millions of dollars at Silicon Valley Bank, didn't give a crap what the bank did with their money because they were pretty sure that if anything went wrong, the government would bail them out. And lo and behold, that's exactly what happened.
Yeah, final question to you then. We've heard there's bipartisan talks now in the House and the Senate. You got lawmakers on both sides of the aisle saying, let's raise the FDIC again above 250. I already know what you're going to say, but bad call or smart call?
No, of course it's a bad call. It's doubling down on a bad policy. It's just going to create a bigger moral hazard, but they're trying to undo the damage from the moral hazard they created by bailing out some banks and leaving the impression that others might be vulnerable. Now they've created a run on solvent banks as people rush to put their money into insolvent banks. But of course, where is the government going to get the money? If they magically insure more bank deposits, that's just another unfunded liability that has to be piled on top of a massive unfunded debt on top of the funded debt that is unpayable already. So it's all going to be inflated away. That's what people have to worry about, that everybody's bank account is at risk because inflation is going to destroy the purchasing power of your money. It doesn't matter if your bank fails because the money that you've deposited in the bank, that's going to fail.